Hello, lecturer of accounting theory. Now we will discuss about the article that discussed about behavioral finance and market efficiency in the time of the COVID-19 pandemic. Next. In this article, we explain how the reaction of stock market prices to the COVID-19 pandemic are explained. The world did not have the recent experience in the last change together of the pandemic that influenced the economic and social life to the extent that COVID-19 has. Therefore, it's not only the coronavirus that is novel, but this level of economic disruption is also unprecedented. In this study, we examine the response of the world's highest capitalized stock market when new stress conditions emerge. A way to reduce the impact of COVID-19 is to adopt the social distancing measure. Under these circumstances, economic activity will significantly decline and the expected returns and growth expectation of the companies will be reversed downward. As a result, stock price will should fall. The study compared the released information regarding the COVID-19 outbreak and the market performance. The main objective is to examine if we should focus on the efficiency of the financial markets or we should include in academic discussion the rationality and predictability of the behavior of the stock price. According to the efficient market hypothesis, all the available information is incorporated in the stock price at any point in time. Therefore, at any point in time, the performance of the stock market should follow the financial theory. If it does not, either the market are not efficient or the theory should be revised. Next. In the following paragraph, we briefly show the investor evaluate asset price. This figure enables us to clearly present the evaluation process traditional finance. A rational investor prefers as high as a possible return at the lowest possible risk. An investor examines several scenarios regarding each final decision. We can see from the scenario 1 is the best case of scenario, such as economic growth, technological innovation, and advance. And the worst scenario is for example, is war, and several probability for each scenario to be confirmed. Next. And then this is for the formula to add the expected return and the standard deviation for the scenario-based approach. This is for the formula for P1 is the probability of occurrence of some financial condition that lead to prospective return, and Ri is the event or the scenario. Next, each investor has several scenarios and consider different possibilities for each scenario to play out in the real world. All the perception of the investor shape of the behavior of the markets. When new information is released, the scenario of the respective probability are revised and influence the market performance. If the investor consider the possibility of negative scenarios such as a pandemic, according to equation 1 and 2, the expected return are overestimated and the risk is underestimated. Depending on the released news, the probability of the experienced scenario to have been changed and or new scenario may be included to the evaluation process. In traditional finance, there is an additional corporate finance approach that enables us to explain how a pandemic affects the market. For example, during pandemic we need to lock down. The slowdown of the economic activity leads a lot of business to reduce the production, which is written to employee dismissal, income increase and reduce consumption, and so forth. In this environment, companies have to reduce the profit, and the growth expectations are revised negatively, and asset prices are reduced because investors will require an increased return in order to participate in the stock market during a negative period. Moreover, the health rate increases the investor risk aversion, which has a behavioral influence on the market decline. Next. According to the popular constant growth model, also known as the Gordon model, the stock price is estimated by this formula, as you can see in the screen, where the P is the value of the stock or index in our case, P1 is the value of the first dividend expected, which has a positive influence on the stock or index price. RREC is the required rate of return or the minimum acceptable compensation for investor in order to bear the investment real risk, which negatively influence the stock price. And then the G is the expected growth rate, which has a positive influence on the stock price. Therefore, stock price will fall when a pandemic breakout because the first one is the upcoming economic slowdown because may reduce the dividend. And then the second is the expected growth rate will be revised downward, and the rate of return will increase because investors will demand higher compensation in order to invest in the risky environment. Next. When COVID-19 is successful, content or the virus is finally defeated, the financial risk associated with the disease will be reduced, and all the aforementioned factors will again influence the market, but this time is positively. Either we adopt the scenario-based approach or the corporate finance-based approach. When new information emerge, the basic measure that leads to the financial decision, equation 1, 2, 3, and this change influence the asset price. If we assume that investors are always rational and asset pricing models are accurate, the stock market will always incorporate all the available information in the price. And then next.
Okay, next I will explain about the COVID-19 outbreak and SP500 performance and what the data say. In order to provide empirical evidence to answer our question, we test our assumption using the data from the US stock market, and particularly the SP500 stock index during the period 31 December 2019 until 31 October 2020 for at least two reasons. The first one is it is the largest stock market of the world and it belongs to the developed stock market. Thus, it will be expected to be efficient. And the US is the country that experienced the highest death tolls from COVID-19 worldwide. So, this is the chart of the performance of SP500 during 21 December 2019 until 30 October 2020. And it divided into 4 sub-periods. For the first sub-period, from the end of 2019 up the PHEIC declaration, the US stock market presents a growth of 1.32% and 0.64% daily standard deviation. So we can assume that the EMH supporters may suggest that the first sub-period, the reaction is normal because there is no official report that something worrying is happening outside Asia. For the second sub-period, after the PHEIC announcement and up to the request for the 2.5 billion supplementary funds and the warning by the CDC, the stock market presents a further growth of 1.97% and the daily standard deviation increases to 0.769%. The PHEIC is a clear message from officials that the health risk can no longer be ignored. And following this declaration, nobody can argue that the news regarding the disease is reassuring. Again, the stock market may have either not incorporated the PHEIC report in their evaluation, or they may underestimate it. The same news, different possible outcome. Theoretically, the news of increases health risk, PHEIC, should lead to negative return, but the reality shows positive return. When the news is similar, the performance of the stock market should not have significant deviation if we consider the market as efficient. Returns that are different than expected may mean that either the stock market significantly underestimated the health risk, or that the theory which assumed a positive relationship between health risk and the risk aversion should be revised. And for the third subperiod, when the negative news of 24 until 25 February was released, the stock market presented a sharp decline and a significantly increased standard deviation because confirmed case and death due to the COVID-19 start to emerge. Period returns minus 13.65% and daily standard deviation 3.75%. This result demonstrates support for the theory. When the health risk increases, risk aversion increases, and the stock price should fall. And the last one for the fourth sub-period, the COVID-19 pandemic declaration on 11 March led to further decline for a few days. However, the announcement of the stimulus pack on 24 March contributed to the stabilization of the stock markets. The stock market during this sub-period presented 13.45% growth and 2.45 standard deviation. Is the rapid growth of the stock market rational during this period? The pandemic still threatened people's life, and during this period, the number of cases and death increased not only in US but worldwide also. Next one, I will explain about the statistical test for the efficiency of the SP 500 index. So in this part, we will present about the descriptive and econometric result of the SP 500 daily return during the period of pandemic. Now, in the table 2, it presents the descriptive statistic of our sample. The charcoal barrel test showed that the returns are not normally distributed. This means that the parametric tests are not appropriate for our sample. In theory, when the markets are efficient, the positive and negative daily return do not follow as a specific pattern. The run test analysis is repeated consequence of positive or negative return, which is a run is randomly generated. If the series is random, which is a basic assumption of the EMH, there is a specific number of runs that should be counted. Otherwise, the time series is impacted by an underlying variable. For a random time series, the expected number of runs should be on average. So this is the formula for the expected number of runs should be on average. And this is also for the standard deviation, and C is the test C status. So U present the number of runs, and P number of positive observation, and N is number of negative observation, and N is NP plus NN, the total number of observation. Okay, next one is the table 3. It presents the finding of run test. For the tested period, we have 211 observation with 90 negative and 121 positive observation. If this time series is randomly distributed, we expect that it will have on average 104 and 223 run, with a standard deviation 7080. The sample shows that we have 124 run, which does not fall within the expected number of runs confidence interval, and this means that we cannot accept the randomness hypothesis. So the main conclusion we draw from this section is that the stock market was not efficient for a long period of the COVID-19 outbreak. In our opinion, something is missing from the traditional financial economics model because the traditional estimation process only includes economic variable. If we quantitatively capture the health risk and fear, we may be able to explain the seemingly irrational behavior of the aforementioned period. Moreover, the fact that the run test showed that the return of the stock market were not randomly distributed implies that there may exist a crucial variable that is omitted from a rational evaluation.
For the next one, I will explain about the number of COVID-19 cases versus the Google-based fear index, which is a better explanatory variable for market performance. Next slide. So, according to Ashraf 2020, he provides empirical evidence that the stock market reacts more proactively in accordance with the increase of confirmed cases than the increase in the number of deaths. It is because the more cases of COVID-19, the lower of the productivity and more fear from the investors, leading to greater risk aversion, and it causes unexpected losses in the economy. So in this presentation, there is the figure 3, which is the SP 500 performance and number of new COVID-19 cases during the period of 31 December 2019 until 30 October 2020. The figure tells that when the COVID-19 cases significantly increase in March, and the stock prices shows a sunk in the prices, but then experience a growth period, this measure can be useful to explain the stock market performance during the early stage of the pandemic. One of the boosts in economic recovery is stimulus package from the government. Meanwhile, when the case also increase, the risk aversion and health risk will also increase. Thus, stimulus package have a positive influence on market prices, while the increased number of COVID-19 have a negative influence. Next slide. So the question is, can the rapid growth of the fourth period be explained? And when the long-held stress period is examined, can it still use the assumption that risk aversion is linked to the number of cases? This means that the number of cases may not be the appropriate measure to incorporate or represent the health risk. Next slide. So this research used a coronavirus fear index or CFI in measuring the health fear. It has a range of 1 until 100. The higher the Google search for coronavirus, the higher the fear and the higher value of the index. The result is that it has a strong negative correlation of minus 0.873. And figure 4 in this presentation it shows that S&P 500 performance and coronavirus fear index CFI during the period of 31 December 2019 until 30 October 2020. So therefore, based on the figure 3 and figure 4, the CFI can better explain the S&P 500 performance during the examined period of December 31, 2019 to October 30, 2020. Then next slide. This research also further investigated using the Granger causality test. So this is table 4 of the Granger causality, and there's also the equation that is used. So S&P 500, it shows the S&P 500 index price, and CFI shows the corona fear index. The Granger causality test shows that there is an unidirectional causality from CFI to SP 500. Which indicates that the CFI is a significant driver of the S&P 500 index price. Next slide. So, to econometrically present the suggestion, they employ a Gauge model using this equation. And in this equation, where the NC is the growth of the number of new cases, and the CFI the corona fear index. And because if the NC and the CFI growth, this means that the pandemic is spreading within the community and that fear is increasing and vice versa. And E, right here, is the error term. And for the variance equation, they use the following formula, where beta 1 and beta 2 are the coefficient of the arch. This is the arch, and this is the gauge. So beta 1 and beta 2 is the coefficient of the arch and gauge term, respectively, and omega right here represent the long-term average value of volatility. The variance equation cannot be negative. Therefore, the omega beta 1 and beta 2 term should be positive, and the sum of the coefficient of beta 1, beta 2 should be less than 1 to secure the covariance stationarity. So, in this table, it also provides the results. Table 5 reports the results of the model. It shows that CFI has a strong significant negative impact on the performance of S&P 500 stock market during the examined period, and the variable of new cases does not have a significant impact. Next slide. So in conclusion, the US stock market did not always react as the financial theory suggests. During the period of 31 December 2019 to 30 October 2020, the price of the stock market doesn't always involve all the available information, which is in contrast of efficient market hypothesis theory. In some periods, like the first sub-period before the PHEIC announcement, EMH supporter may assume that the positive returns and the low standard deviation is rational behavior, because no worrying news was confirmed by officials. However, can we say the same for the positive return during the second sub-period when the PHEIC was announced but no stimulus package were announced? Afterward, even with the delay, the stock market finally incorporated the health risk and the stock prices fell. This is consistent with the stock market's delayed reaction when systemic issues emerge. And the second one that we get is the investor overweight the information that a stimulus pack will boost the economy, but they seem to underweight the previous information that the COVID-19 pandemic, which led to the financial crisis, still exists. So during the third sub-period, up to the pandemic declaration, the stock market presents a sharp decline, which is rational behavior. However, when the stimulus package was announced on March 24, a rapid growth period followed that day, and the post-pandemic declaration period presents a 13.45% growth. Is this behavior rational? and the number of COVID-19 cases and deaths increase, but the market seems to react as if COVID-19 has been defeated by a medicine or a vaccine. So investors overrate the information. And then the third one is in a longer time period, CFI based on Google search can help to define the fear of pandemic. It shows statistically negative impact while the new COVID cases can provide results. So in the early studies, it shows that the number of new COVID-19 cases is an appropriate measure to explain the market decline during the initial pandemic outbreak. However, the negative relationship was not confirmed when a longer period of time was tested. Therefore, this measure does not incorporate the fear index. So we employed a coronavirus fear index in this research. So the researchers employed a coronavirus fear index based on Google search, which enable them to incorporate the health risk into financial market analysis. The higher the number of Google search using the term coronavirus, the higher the fear of the pandemic. Using a Granger causality procedure, they show that the CFI drives the stock market prices, and applying a Gauge model, they provide empirical evidence that the CFI has a statistically significant negative impact on the stock market performance, while the new COVID-19 cases do not. So finally, this paper provides empirical evidence that in the 2020 pandemic period, some data that were initially considered as the most appropriate variables to explain the market performance, which is the COVID-19 cases, should be revised, and that a Google-based fear index that the paper suggests in this study better explains that the US stock market behavior during the examined period. The empirical evidence showed that the index incorporates a significant behavioral variable, which is the health fear, that is generally missing from the EMH model. This means that the Google-based fear index may contribute to build more accurate models and to understand how the financial world works in a period of extreme health stress. So concluding this study, they show that when extreme conditions emerge, economic variables alone may not be sufficient to explain the market behavior. Financial decisions do not always wait for the next official financial statements or the economic indicators to be announced. Behavioral factors such as fear may be a better indicators to explain investor decision, and Google search may be a useful tool to quantitatively incorporate the behavioral influence on financial models and bridge the gap between the behavioralists and EMH supporters. The findings show that fear of COVID-19 was at its highest level up to mid-March, and afterwards, it started to decline. The increase of the fear explains the market decline, and the reduction of the fear index in combination with the stimulus package explains the rapid growth period. Possibly, a prolonged pandemic and a protracted period of health risk lead to the situation where citizens and investors are getting used to the idea of COVID-19. Further, studies based on the internet-based behavioral indicators like on a Google search or Twitter may enable the study to bridge the gap between the behavioralists and the EMH supporters and build more accurate models. Now, next slide. So that's all for our presentation today. Thank you for listening.